welcome to Strictly Money at the News Forum. I'm your host, Saijal Patel. Are you looking for ideas on where to invest? If you haven't looked at Asia, you may want to rethink your investment strategy. Asia has delivered some of the biggest returns in the world over the past 20 years. And with huge demographic shifts, economic reforms, and relatively low debt to GDP ratios, it makes sense from a growth and diversification perspective to have exposure to the region. I'm really pleased to have my next guest on today's show. Herald Vanderland is the head of Asia Pacific Equity Strategy at HSBC, and he's written a book, Asia's Stock Markets from the Ground Up, to help investors better understand the region. And he joins me now from Hong Kong. Herald, it's great to have you on, and thank you so much for staying up late today.
Yeah, good morning for you, good evening for myself, that's right.
So, Herald, I lived in Asia for 11 years, and I have tremendous appreciation for the region's diversity. It offers incredible investment opportunity for investors, and yet I've always felt that it's been misunderstood. It's lumped sometimes into one bucket. It's seen as synonymous to China. That's my take. Why do you think Canadian investors need to look at Asia?
Well, there's a couple of reasons to look at Asia. I mean, normally people say you're going to look at it for growth. And that's right. Actually, as you mentioned, some of the Asian stock markets over the last 20 years have done actually tremendously well. Some of them about twice as good as the S&P 500. So there is growth in certain industries and you can benefit from that. But I think there's another reason that makes Asia interesting. And that is Asia is actually moving on its own sometimes. It's not correlated. It doesn't move what happens in the US. So if the US has got a bad time, some of the Asian markets can do very well. That's also within Asia. Certain markets move in the opposite direction. We've had this year China not doing very well, but India actually had a stellar year. So it's these kind of differences that you can benefit from if you have that in your portfolio.
Let's talk about demographics, because this is always the big focus, right? You have a lot of different trends that are going on. One is the aging population, which, Herald, you see here as well, but there's different dynamics at play. So how does that fit into opportunities there?
Now, I'll give you a good example. So very often people think that aging is a bad thing. Aging populations means there's a lot of older people that maybe not working anymore, and therefore that's not good for the economy. That's the general feeling. To a certain extent, that's right if you're in maybe Canada or Europe or other places. In Asia, it's different. We don't really have pension systems in a lot of countries, and if they're there, they're relatively new, so it's not sufficient. So most people will have to work after they're 65. And that actually makes sense as well. If you're 64 years old in 364 days, you're accounted for as being productive, and the day after you turn 65, you go into the statistics as not being productive anymore. But in Asia, it's not the case. You see in Japan, you see in Korea, people working well into their early 70s. And this has certain benefits. They accumulated a lot of capital, for example. And that needs to be reinvested. That goes, for example, into stock markets as well. One good reason to buy actually Asian stock markets is there will be a lot of Asians going to buy over the next 20 years as they prepare for their retirement. So that is one of these examples. Another one could be something like a trend of empty nesters that is emerging in China. People are getting older in China. They're going to their 40s and 50s, a lot of them. Yeah, that's when your children leave. And if you get one child policy, then you become an empty nester. And that means you're with the two of you. And suddenly, these people have done very well. They've got property. They've had a good career over the last 20 years, make money in property, as I said. So they're well off, and they're going to buy better things. And they're going to travel. They want to go to Canada, amongst others, seems to be top of their list. But they want to go to good restaurants. And you can buy that. You can buy travel agents. You can buy these restaurants. You can buy the liquor companies that sell these products to them. You can buy the wealth management companies or the insurance companies that benefit from them as they try to prepare themselves for retirement. So lots of ways to play that, actually.
Yeah, and I think what people may not appreciate, at least here in North America, is that the savings rate is relatively high in Asia compared to here. And that actually leads to another demographic is the rising middle class as well.
Absolutely. So you're right. The saving rates is extremely high in Asia. I wouldn't even say it's a little bit higher than, say, in the US. I don't know what it is in Canada out of the top of my head. But in China, people save about, say, 40% of their income.
Mm-hmm.
That is a lot. In the US, it's about close to zero or maybe a few percentage points. That means, they got to put it somewhere.
Right.
In the past, it was property and gold. But now they put it into bonds, they put it into equities, second property, all kinds of other stuff.
Welcome back. I'm here with Herald Vanderland from HSBC. Herald, let's talk about specific stock markets. We have a board that actually shows you that if you had invested $100 back in 2000, where you would be. And you can see some of the top performers, China's Shenzhen market, India Sensex, and then Hong Kong as well. What has been some of the drivers?
Well, first of all, if you look at these markets, you see there's a very wide divergence. So Japan is at the bottom, would only make you, I think it was just over $100 or something like that. So there's a big difference there. You also see there's different markets in China. But the key drivers to a certain extent have been very often that in Asia, certain industries have emerged out of nowhere and have become globally competitive. A very good example, India, for example, is at the top of that list. We've seen their IT companies. Y2K was a big thing 20 years ago. If you can't remember, we thought the computers would stop working in the year 2000. It was Indian software companies that started to investigate these matters. And people thought, well, these people are pretty good. We can do all kinds of other services with them. And so they built actually global businesses, pharma as well. So that's been a case. Now, of course, the rise of China, the economy has done enormously well. So we've seen a lot of new companies moving into these markets and have performed extremely well as well. So that the economy has emerged.
Herald, you talked about the differences in the Chinese markets, and I think that's an important point to make because the market composition is not the same. You know, the Shanghai is different, Hong Kong's Hang Seng is different, as well as Shenzhen. Can you talk a little bit about that?
Yeah, absolutely, because this is a very important difference. If we talk about the American stock markets, most people think about either NASDAQ or S&P 500, or you look at the Dow Jones. But pretty much the S&P 500 and Dow Jones, there's not too much of a difference in that. In China, there are more than one stock market. Arguably, there are 4 or 5 at least. Beijing just opened up one, is really small. You got a kind of a techie market in Shenzhen where tech startups go, but the big one is really Shanghai. And Shanghai is industrial companies, consumer companies, banks. One of the biggest ones is, for example, so here you see China, that is those 3 exchanges, Beijing, Shenzhen, and China, Shanghai, India. And that is really traditional companies, retailers, footwear companies, liquor companies, stuff like that. Hong Kong has got a lot of Chinese companies as well, but that's a separated kind of market. And that's where a lot of the tech companies are located. So you're talking about the Alibabas and the Tencents and Xiaomi and stuff like that. So very different markets. Now, if you talk about the Chinese stock market, we have to say which one you're talking about, because that can go down, but Shanghai can actually do very well because it's a very different kind of sort of stock market.
And then, so as an investor, how do you play China, right? You have A shares, which is really for domestic investors. Is it B shares? Would you actually think about looking at different markets where you can play China, like Singapore or Taiwan?
Probably for most investors, there are 3 ways to play China. Hong Kong is the easiest. If you can just buy stock in Hong Kong, you can go there. And as I said, it's mostly tech companies, but there are banks and all kinds of other companies as well, industrial companies, retailers, footwear companies, you name it. If you say, well, I don't know how to go to Hong Kong, I just want to trade in the US, that's easy as well. There are ADRs trading or Chinese companies listing in China, although the US has made it increasingly difficult for these companies to list there. So a lot of them actually delisting and moving to Hong Kong. And you can go to Shanghai. Now, that is not necessarily easy, but you can do that through Hong Kong. We call it the Stock Connect. You just need to sign a paper with your broker that you are willing to do that. And then in Hong Kong, you can buy Shanghai stock. And there's a limited list what you can trade, but most people it's more than enough. So that's another way of playing China. Or you simply buy an ETF on each of these markets.
Herald, we only have about a minute until we go to our next commercial break. What about the export-dependent markets? Traditionally, maybe China, but as well as Hong Kong and Taiwan. When I was there, we knew that they were very dependent on the US economy being the largest economy in the world. Are you starting to see some sort of a shift where there's maybe less correlation and greater diversification around that, or is it still the same story?
Well, for China, it has shifted. So China used to be an export market. It is not anymore. The ones that are really export markets in particular are Korea and Taiwan. Taiwan makes your Apple stuff. It's big in Apple. So it puts the phone together, puts the chips in there, the cameras, everything. So anything with Apple, you can play through Taiwan. Korea is, of course, more Samsung-centric. It does memory chips. So it's a slightly different dynamic. But yeah, they got Korean car companies that sell all over the world, including Canada. Right. So they are very export-oriented. So if exports do well, the US and Europe do well, hey, these markets can actually perform pretty good as well.
Welcome back to Strictly Money. Our guest this show is Herald Vanderland, Chief Asia Equity Strategist at HSBC. Herald, I want to use this segment to talk a little bit about China. Obviously, a lot of interest from our point of view, but I've always said, unless you're there and unless you're on the ground, it's very difficult to understand really the nuances because you have to read between the lines. I want to get your take specifically on the political backlash that has emerged and what that means for the Chinese economy.
Good. So clearly, China and the US are having an increasingly antagonizing relationship. And this has got implications for what China is doing. It has taken a good look at itself and said, we have a couple of areas where we are pretty weak. One of them is actually debt. Debt levels are high, so they said we need to address that. And they're trying to work their way through to reduce debt situation. But maybe more interesting for us is that they've identified certain industries that they believe they need to grow. Semiconductors is one that catches a lot of the headlines. They want to grow. That's not easy, but they're putting regulations in place in order for that industry to flourish. Energy is another one. They are dependent on energy from outside, and therefore, they try to build up wind and solar, for example. Two largest solar panel producers in the world are Chinese. Food is another industry. Automation is another industry. High tech in general is kind of the new growth development kind of model that they're trying to develop. So it's these industries where they want to be self-dependent and not reliant on the rest of the world, in particular the US. And these industries, they allow them to grow. Good thing is, some of these companies are listed on the stock exchange. You can actually buy them. And sometimes you don't have to buy for the big companies that are prominent. You can look at the component makers or go deeper into food chains and see where interesting companies are. And so that's how we can play that story.
Herald, you talked about debt. How big of a risk is bad debt in the property sector? We've paid a lot of attention to that, and obviously, Evergrande made headlines.
Yeah. In a sense, what we've seen so far is only the beginning. There is a lot of debt in China. They notice that, as I said, they see this as a vulnerability. So they're trying to deal with this. The way to deal with this is you tell the markets, we're going to do this. Then you do it in small steps. Then you do your bigger steps, and presumably Evergrande is one of them. And then you go on with that. And you're trying to restructure that debt. A lot of it is 2 or 3 year old debt, so they have to repay it in 2 or 3 years old. Maybe you can restructure and say you can repay it in 5, 10, 15, 20 years. So that's one way of restructuring it. And with that, they hope that they can generate sufficient amount of growth so that over time, these debt ratios start to diminish. That's the plan. We'll see if that works.
How smooth do you think this transition to being self-sufficient will go? And maybe a better question is, how dependent or how much do they need the US and maybe even Canada? Or can they increasingly look at other markets like, Africa and South America?
Yeah. It will not be necessarily smooth. I mean, I used to live in Taiwan 20 years ago. People were talking about the Chinese going into semiconductors and competing with the Taiwanese. Where 20 years later, they're still not competing with the Taiwanese. They're still ahead. So they struggle to catch up for a variety of reasons. It's just not easy to do so. that means that they remain vulnerable in that area, and they try to reduce that by, for example, trying to build up new markets. Africa is one, Latin America is another one. The rest of Asia, of course, is very close. Europe is another one. That's one of the things that they're trying to do while they're trying to catch up. So it won't be a smooth process.
Yeah.
They have, on the other hand, also some bargaining chips. China's got rare earth. So if the US says we're not going to sell you chips anymore, they say, well, we're not going to sell you rare earth anymore. So sometimes these countries have to work together with each other as well.
Right. Herald, we only have about 45 seconds, again, until the break. What do you think the vision is for Premier Xi Jinping compared to the last Premier Hu Jintao? Because it really does feel like a different China under his leadership.
Absolutely. I think he, as a personality, is very different. I think they want China to become a middle income to maybe almost higher income country that is well respected over the course of the next couple of decades. He understands that there are certain challenges that we just spoke about. There's debt. They're going to find a new growth driver for the economy. The old property story that's not going to work anymore, and that's where they're trying to focus on.
Okay. Okay. We'll take a quick break and we'll be right back. Welcome back. Herald, before the break, we were talking about China. I want to get your thoughts on India. They often compared to China, a very, very different market. What's some of the drivers in India, and what sectors do you see that has the most growth opportunity?
So India is a completely different market than China. It is much more diverse. It doesn't have these large tech companies that are listed in Hong Kong. It's basically pharma and IT software companies that are the bigger exporters. And then you have a lot of domestic companies, of course, banks, but in particular retailers. The thing in India is that it's incredibly difficult to get goods around. And a lot of Indians live in townships, villages, smaller towns, scattered across all of India. While in China, for example, a lot of people live simply in Shanghai, Beijing, in the larger cities. India is much less urbanized. So you need to find companies that actually can get the goods to these people, to that massive consumer market. So you need to find companies that have channels, distribution channels. So you're thinking about retailers of jewelry, or there's a company that sells soap and toothpaste and stuff like that. But what you look at, can they get the stuff into the small stores right in the middle or in the south, north, east, west of India? And some of them have. And they have, therefore, become some of the most profitable companies in the whole of Asia.
Yeah, are you, is it still really dependent on small and medium-sized businesses because of this factor? You know, a lot of people still live in rural industries. And so does that make it difficult to find more publicly traded big companies to invest in?
Actually not, because it's the biggest market. In a couple, 3 or 4 years' time, India will be the most populous country on the planet. So you have an enormous consumer market, and some of these companies have become really behemoth. So you can actually pick some of the larger consumer names in the Indian market, and look at their distribution and say, hey, that's not a bad idea. Let's play that story here. And they've performed.
And they also have a very young workforce. Another place that has a very young workforce, and a market that you really like is Indonesia. Tell us about that.
Absolutely. I think I've looked at Indonesia for 30 years. I used to live there in the 90s for about 10 years. There's something really interesting going on in Indonesia. And if people want to look for another market than, say, India or China in Asia, I think that's one you should take a very close look at. Indonesia's got a young workforce. It's actually built a lot of infrastructure. So that means that second and third tier cities are growing very well. It's chock full with nickel, and all the electric vehicle battery makers need that stuff. So they're going and investing there. That creates all sorts of employment opportunities in Indonesia. So a lot of things going in the right direction for that country for the moment. So we like it a lot, absolutely.
Okay. One of the issues that I found that actually plagues both India and Indonesia is corruption. And in the past, that has deterred foreign direct investment. Do you think that has changed?
Yes. It has improved. So in the 90s, when I used to live there, kind of these issues were very endemic. Indonesia has put in place an anti-corruption body that has worked very well and has picked up all sorts of politicians and other officials over the last couple of years. So they've really worked on that. It doesn't mean that these places are corrupt-free, far from it, but they're trying to improve on these issues. On the other hand, it's something that we also know exists, and therefore that's been priced into markets. We know that there are, sometimes these issues take place. Asia trades at a discount, for example, to the US. It's one of the reasons why this is the case. The governance is not as perfect. We just have to admit that. Mm-hmm. But that is reflected in share prices to a large extent already.
We're coming to the end of the show, and I do want to talk about your book very quickly. It's Asia's Stock Markets from the Ground Up. Why did you write it, Herald, and what can readers learn from it?
Well, I've written it for a very simple reason. I think people should look at equities. If everybody wants to be financially independent, for that you need to invest. For that you need to be in equities, and I think you need to have some money in Asian equities. I tell that to my friends, but they didn't have a finance background. And if you read most books on stock markets, they're kind of pretty technical stuff, math and stuff in it. You needed to have a book that was just easy to read and for people just to easily understand how these markets work without all the technicalities and the jargon that we in the finance industry are so good in throwing around. So I try to make it a very easy read and a very easy way to understand these markets without all the technicality.
All right, Herald, thanks for coming on. And for those interested in the book, they can pick it up on Amazon. There's a Kindle version there. Herald Vanderland from HSBC, thank you.
Thank you.
Thanks for watching Strictly Money. Happy holidays.